Hello, everybody. Thanks for joining us. This is Hunter Satterfield. I am the Chief Investment Officer and one of the partners here at CWA. As always, I am joined by my fellow partner, Brian Bortz, who is also the head of our investment committee here at CWA. And this is your July monthly update. For the month of July, we had a lot of positives. The S&P 500 was up 9.2%. Global stocks were up 7.1%. Domestic bonds were up 2.4%, and global bonds were up 2.1%. And obviously, we've positioned here on this slide here the difference between what happened in June and July, and it's a stark difference. We're seeing this huge, swing between what we saw in June with a down month and a positive month here in July. And a lot of clients are asking, both Brian and I and our other advisors, why is this happening? And in reality, what it is just the Fed continues to lead things with how they script the meetings, the minutes of their meetings. And what they're scripting right now is while we are going to continue to look at increases in interest rates, we also probably have a little bit of some recessionary fears. And so that emboldens a lot of investors to go and find opportunities for buying in markets that are down like June. So it's been a really interesting 60 days for us. And Brian, I want to come over to you and talk a little bit about, okay, we've got a huge down month in June, and it looks like things are on the positive upswing in July. From your perspective, I'm sure you're getting this from some clients as well, because I am. I mean, I guess the question is, are we out of the woods yet?
Yeah, thanks, Hunter. Man, the answer to that question is I don't think so. We have been talking about for well over a year that bumpy ride up that we talk about. And we've talked about volatility, and that is a theme that will continue. The difference between looking at a down month like June, where the S&P was down over 8%, and an up month like July, where it was up over 9%, is that nobody really cares about upside volatility. Everybody likes upside volatility. It's still going to happen. If we look at what is driving this, the Fed gives out markers and clues of what it's going to do, but there is a lag in the market to the economic data that comes out. So when the Fed raises interest rates, you may see a big move in one day, but it'll reverse itself typically in the next couple of trading days. What you don't see is what happens when the Fed raises interest rates. The economic impact doesn't really show its head for another 2, 3, 4 quarters. And so these massive moves that we're doing coming off of zero interest rates and going up to a target to try to curtail inflation, you're going to see that economic impact quarters down the road. If we go back to what Brad said last month in the investment update, he talked about a bifurcation in the market. And what he meant by that was there will be certain sectors that will start to behave better like they did in 2000. But the overall market as a whole is pretty weak, and we're still having recessionary concerns. So I think while it feels good to be up as well as July was, every investor should keep in mind that volatility is still going to be the theme of the rest of this year.
Yeah, no, I completely agree. And thanks for those comments. One of the things that I've talked to a lot of clients about is, while we are seeing some continued volatility and obviously a down year this year, one of the really helpful exercises mentally and psychologically is to actually go back and look at your account returns from the beginning of 2019 until right now. And while the market is down this year, and while we had a struggle in the spring of 2020 due to COVID and the shutdown, if you look at the beginning of 19 until now, any well diversified account is going to be up 7 to 10% per year over a 3.5 year period. And that continues to be the focus. And one of the things that, we're telling investors and we want you as viewers to be able to hear as well is that, if you're somebody that's got near-term or long-term investment goals, near-term, long-term, while this is going to continue to be a volatile market overall as we head here into the fall, it still is a great opportunity to invest for the near term and long term, to keep your investments going, to keep those steady contributions going, because ultimately your long-term returns will still look very, very good overall. So that's what we continue to, go to clients with. And while that doesn't, fulfill or answer all the questions for clients who are maybe in the short term, I think the short-term answer is what Brian said: continued volatility, and the long-term answer is continued optimism for where we're going. So thank you so much for joining us this month. And we will be back in front of you with what is likely to be a continued bumpy ride this fall. We'll be back in front of you next month. Thank you so much.